Now with the changing dynamics in terms of the macro picture, how do you want to kind of realign your investments? So if you recall over our last few FINLIT sessions, what we've kind of covered, we've mentioned three key things that were going to happen. One is that interest rates are going to crash post a domestic debt restructuring program or domestic debt optimization program. Inflation will come to single digits, and which has already happened last month, where inflation is down to about 6%. Next month, you're going to see inflation coming down even below, right, to below 5%. And the third main point that we said also was that the rupee will start stabilizing, which we saw where the currency went to 360 and is now kind of settling down at 320 to 330 levels, right? So from a macro perspective, we've seen changes, right? Now, the bad side of it is that if you were an investor in fixed income securities and you were making large interest gains, now when your deposits and your fixed income instruments are maturing, you are going to see your returns starting to come down, right? So tactically, how do you kind of align your portfolio? If you have a set of treasury bills, fixed income deposits, fixed deposits, savings accounts, money in the equity markets, how do you kind of realign yourself in the current context in terms of the macro picture? So if you look at the first section, what has changed after the announcement of a domestic debt optimization program, right? So if you look at the chart here shows the bond yields before and after the debt optimization program. So the orange line is basically showing at each tenors, 3 months, 6 months, going up to 10 years, what the yields were on the bonds, treasury bonds before, and what the yields are today, right? If you look at the yields today, roughly rates have fallen by almost 10%, right? At the peak, you saw 10-year bonds trading at 30%. Today, they are trading at 13.5%, right? A substantial adjustment has happened on the treasury bond yields, right? And treasury bill rates have also started falling. Now, you see the 1-year rate closer to 14-15%, and the 3-month rate close to 18%. But we are seeing continuous adjustment downwards even on the treasury bill rates, right? So in this context, how are we going to manage our portfolio is what we're trying to kind of address, right? So all this time, there was a risk attached to the restructuring, right? So because of the restructuring, we saw treasury bond yields shoot up. Now, when you take a risk out of the equation, because domestic debt optimization has taken away the risk of default or restructuring, you're seeing now interest rates starting to come down on the treasury bonds, right? So we won't be able to enjoy that 20% plus kind of returns that we had a couple of months ago, right? So that's almost gone now, right? So you're looking at a new interest rate regime, right? So you shouldn't benchmark yourself thinking that you can still make 20% plus returns in this market, right? Or on a fixed income security. So you have to now kind of look at ways and means where you can kind of make higher returns, right, given the current inflation scenario. So now interest rates have fallen. Interest rates have come down to about 13-14% on bonds. Do you think that interest rates will fall even further, or are they going to stabilize, right? So from our perspective, what we feel is that there is further scope for interest rates to come down. And I'll tell you why, right? So from a policy rate perspective, what you mean by policy rate is the rate which is set by the central bank, right? Which is the underlying interest rate of the economy. Now, when central bank changes the policy rates, automatically you see all of the interest rates following suit in terms of reducing, or if they're increasing, it will increase, right? But the central bank policy is now based on two main things. One is the inflation levels. Now, if inflation is coming down, automatically it kind of gives more headway for the central bank to cut policy rates even further, right? Already we've seen the central bank cut policy rate twice, right? And from our perspective, we are expecting another 200 to 300 basis, or 2 to 3% of interest rate reduction facilitated by the central bank itself, right? And what is helping that stance is the inflation levels. Now, we saw inflation levels at 6% last month. It's going to come below 5% this month, right? And central bank is expecting that inflation could be even in the disinflationary territory or in negative levels, right? But given the current low inflation levels, we feel that the policy rates are going to be reduced even further by the Central Bank of Sri Lanka, right? And why? So one is that inflation is coming down. Second is that if you look at the left-hand chart here, the black line shows what our GDP projection would have been if Sri Lanka didn't go through a restructuring or a financial crisis, right? The red line here shows if because there was the financial crisis and there has been a restructuring in the economy, what the new GDP potential is, right? So obviously a new GDP potential is lower than what it was before, right? But the point is that the blue line is showing where we are actually today, right? The blue line is still showing that your GDP growth is even low below the new normal long-term GDP growth rate, right? Which means that our growth is not sufficient for the economy, right? From a central bank perspective, it is not achieving the desired level of economic activity, right? So in order to induce economic activity, the central bank will be forced to kind of take a more accommodative stance. When I say accommodative stance, they are going to allow you to kind of reduce interest rates further or give out or increase the money supply in the market, right? In order to facilitate more lending and through that to kind of drive GDP growth, right? So one is that inflation is coming down. Second is that the GDP numbers are below than expected, which is going to facilitate them to take a more accommodative stance. So another development which happened during the last week was that central bank did something else, right? They reduced the statutory reserve ratio, right? Which is the amount of deposits that banks have with the central bank, right? So it used to be 4% of the deposits was with the central bank. Now that has been reduced to 2%, right? So what happens is that when banks are required to have less amount of money with the central bank, the remaining 2% comes to the market, right? Because it's a release of funds, whatever that they were having with the central bank has now been released, right? So that money is now out there in the market, and that will be applicable from tomorrow, from 16th of August, where the 200 billion rupees of money will flow into the market, right? So now effectively what happens tomorrow is that banks will have more money to lend, right? There will be more supply of money in the market, which is effectively going to push down interest rates further, right? So now you will start to see even the short-term lending rates, for example, or short-term rates on treasury bills and so on, starting to come down, right? So at the moment, 3-month treasury bills are hovering around 18-19%. So even that might start coming down in the next few months, right? So from our view, what we're expecting is that treasury bill rates will effectively kind of have to settle at between 10 to 12%-ish, right? It might take a couple of months, but it's going to come there, right? And your borrowing rates in terms of what you call as average prime lending rate will also follow suit and come down to 13.5 to 15%. Already central bank is on the case of the banks to reduce the lending rates, right? And we're going to very soon see banks also being forced to kind of cut lending rates, particularly with the amount of monetary supply that's going to come in with the SRR cut, right? So A, inflation coming down, B, the completion of the domestic debt optimization program, which has now been extended until 31st August, and the amount of money printing, which has already stopped, right? All these is going to facilitate interest rates to kind of come down to these levels that we expect. We might be here or there, but overall trend is still downwards, right? So we know that interest rates are going to come down, right? The landscape is changing, inflation is adjusting down. How do you kind of manage your money and where do you put your money into place, right? So if you recall from our previous sessions, we used to emphasize more in terms of investing long-term in terms of treasury bonds, where we wanted you all to lock in your rates at 20% plus levels, right? Now we suggest that don't lock in your rates in terms of treasury bonds for a longer period, right? We're asking you to look at, in the short term, how can you optimize your returns? Because personally, we don't feel that it is a great opportunity to park your money at 13% for a long period of time, given the risk attached to Sri Lankan inflation and the possibility that we can derail ourselves in terms of our fiscal outlook and so on, where we might come to another problem in a couple of years' time, right? So a 13-14% rate on a treasury bond is not attractive compared to a 20% level, which was there a couple of months ago, right? So a couple of options that we feel in the current context looks more attractive, right? Unit trust, we've been talking about unit trust, but to be honest, as a product, it now looks more attractive than what it used to be before. And I'll tell you why, right? And the second product is what you call the share market or the equity market. Like what we said, after domestic debt optimization program, you see markets picking up, equity markets picking up. We've already seen the equity market starting a movement where index was about 9,000 levels. Today we are trading at 11,000 odd levels, right? So index has already started moving up, right? And third component, which has still not come to the market in a big way, is debentures, right? So if you are to go long run, which we are saying be restricted, don't go too long right now. If you are going long term in terms of investments, look at debentures where you can make a premium compared to the normal treasury bond rates, right? Still, we haven't seen institutions coming to the market actively in terms of treasury, in terms of debentures, but very soon you'll see financial institutions and so on coming to the market for debenture issues, right? The good thing with debentures is that previously we had all a concern in terms of the credit quality of companies, right? So we kind of stayed away from investing in corporate debt because we were concerned that some companies can go bust. Overall, the credit quality of companies were bad. But now with economic recovery kind of starting to come into play, we are seeing even the corporate debt, if we can get a premium over the treasury debt, right, will still be an attractive proposition in the coming months, right? So these are the three products that we are kind of focusing on, right? But if you still want to lock in for 3 months in a treasury bill, the rates are still attractive. It's at about 18% right now, right? We wouldn't recommend going long on the treasury bonds or even taking the 1-year T-bill position. But if you have a shorter term mandate where you just want to take risk-free instruments, a treasury bill rate at 18% is still attractive for a normal investor, right? So, as you know, roughly more than 70% of retail investors keep their money in FDs, right? While the 30% is in savings deposit, which is absolutely doesn't make any sense in the current economic environment, right? So even on this fixed deposit component, why are we saying that stay away from fixed deposits, right? So the reason being that if you look at the FD rates of banks have fallen substantially, right? So if you look at the rates which were there before, bank FD rates were between 15, roughly averaging about 17% a couple of months ago, right? That was in January. Today rates are at 10 to 11%. So when your FDs are maturing, right, these are going to reprice at 10, 11%, right? Now, is this return sufficient for you to keep investing your money in FD, right? 10, 11% accumulating in a country which typically has a long-term inflation of about 7, 8%, right? So bank FD rates have fallen sharply, right? So, and also keep in mind that if your total income, right, including your salary, and then when you add interest to it, if that is crossing 300,000 rupees or 330,000 rupees a month, you're effectively going to pay 36% on your FD interest, right? That's basically wiping away more than 1/3 of your interest income, right? So effectively think about it like this. If you're falling into that 300,000 income category, right? If you make 11% on your FD, after tax, you will only get 7% to your hand, right? And your inflation, which is at 5%, right? So you're only getting, if you numerically work it out, you're only making about a 1% premium over the inflation rate on FDs, because that's what you're getting to the hand is only about 7% interest rates as cash, right? And this is only applicable if you're falling into that 36% category. But now we see most of the people coming to the 36% category because if your salary automatically crosses 100,000 or 200,000 range, and then you're making an additional component on fixed deposits, that automatically normally tends to go into the higher brackets, right? So because of that, right, your after-tax FD returns are now looking very bad or not lucrative if you're falling into that tax category, right? So our suggestion, moving on. So our suggestion would be the unit trust products, right? Now, why I've explained what a unit trust is. It's a pool of, we pool funds from multiple investors and park it in various instruments, giving you a consolidated return, a weighted average return of that portfolio. You can even start small, even with a low amount if you want to, right? But I understand the question that you all would have in terms of how unit trust can give a very high return, right? Now, these returns that we put in here are the returns over the last 2 months in terms of what our monthly annualized return was, right? This doesn't mean that we're going to continue at these kind of rates, but we will be able to provide a return way higher than what the banking system will provide for the next 12 months at least. And I'll tell you why, right? So the reason why we will be able to kind of provide a higher rate is because of a maturity profile, right? So what we've done is strategically parked a large part of our money in long-term instrument when rates were high. So what we've done is we made a call. We saw these interest rates were going to come down. So as an investment company, our unit trust arm did one thing where they parked roughly about 46% of the fund in long-term treasury and corporate debt, right? Which is yielding very high returns, right? So now you locked in 40% of your fund in very high returns, right? So if you wait the returns out, you'll still be able to enjoy a 20% plus return for the foreseeable future, for at least the next couple of months for sure, right? Unless we've seen a doubling or tripling of in cash inflows coming to the market, we still can comfortably give a 20% plus return for the next couple of months, right? So our advantage and why we are able to give a higher return compared to market is because of a call that we made on interest rates. And our fund has locked in a large part of our portfolio in high yielding fixed income instrument over the last 3-4 months, right? So also keep in mind, there is a tax play with the unit trust as well, right? So in FD, every time you get interest, right, you have to pay taxes. The 36% tax is applicable on the interest that you make, right? But and how the taxation works in Sri Lanka is on realization, right? When you're getting interest to your hand, you need to pay taxes, right? But with a unit trust, right, because you're not getting the interest to the hand, if you say, for example, if you put money in the unit trust, and if the interest is just accumulating on the fund without you withdrawing the money, right, you can postpone this tax payment, right? So effectively, you're not realizing the cash flows. If you take money and just park it in the unit trust, and unit trust is earning the interest, and the interest is accumulating in the fund, and your unit price is every day going up, right? So if you don't withdraw the cash, right, and keep accumulating money in the unit trust, right, you can postpone this tax payment, right? So for example, we've shown an example where on a 20 million rupee deposit, right, say the rates were 25%, you make a 5 million interest, right? On that, every year you have to pay 36% tax, right? And we've shown a scenario how your tax changes, right? But here also we show a scenario where if you keep the money in the FD in a unit trust income account, right, even if you have 20 million, which is making a 25%, the 5 million interest, if you're not withdrawing the money amount, right, you don't have to pay taxes on those years, right? You will only pay, say for example, you keep accumulating in the account without withdrawing it, you only have to pay tax at the point of withdrawal, right? If you keep for a longer period of time, right, you pay for the cumulative layers, but you have a time value of money because your cash is not going out as of now, right? So we are postponing your tax payments, right? And sometimes there's a very likelihood chance that given that the government's collections are not too great, they might look at just increasing the WHT or the withholding tax on or implementing a withholding tax on or increasing the withholding tax on bank deposits and unit trusts and so on. And they might take out the option of having an income tax of 36%, right? Because collections are going to be difficult in terms of income tax. So if you feel that income tax on FDs and so on is not practical and it's going to come down in the future, you're actually better off keeping the money in the unit trust, because at the point of redemption or withdrawal, you only pay the tax rate which is applicable at that time, right? Say, for example, if in 2 years' time or 3 years' time, this 36% becomes 12% or 15%, right? So you don't have to pay 36% on each year. You will only pay the 15%, which is the rate prevailing at that time as the tax component, right? So effectively, you save a lot in terms of the taxation in the future, right? So one thing is, if you don't have money that you want to use on a day-to-day basis, you can postpone the tax payment right? You can postpone the tax payment by investing the money in the unit trust, right? So two benefits from the unit trust. One is that you're earning a higher return because of an advantage of being able to lock in large part of a portfolio into long-term instruments. Second is that the tax benefit that you can make by postponing your payment, right? So these are two key benefits by what you will see with a unit trust product. So just to talk a little bit more on the unit trust, our unit trust, we've been operational since 2012, right? Our returns have been always greater than what you would make on FD, fixed deposit. And this in addition to the liquidity that you get, because in a unit trust, you can withdraw money whenever you want, right? So you might have a question in terms of, okay, if everyone's asked for money, how do you pay it if you have large part of your portfolio locked in long-term securities, right? The thing is, these long-term instruments are more liquid, right? So we can short it, we can sell these long-term instruments, and they're already on a gain, right? So we can kind of capitalize on these long-term products if we require. So there's no problem with liquidity as such, right? And over the years, we have kind of, if you look at AWFDR is basically the bank deposit rates, average weighted fixed deposit rates for each of these years. And if you look at it, the three funds that are shown are the investment grade fund, CAL Income Fund, and the CAL Fixed Income Opportunities Fund. The Fixed Income Opportunities Fund was only launched in 2022, which is why the purple bars are only visible from 2022 onwards, right? But overall, we've been historically outperforming the market. And that's because of our investment, where we have access to better investments that as a typical retail investor, you won't have. And second is our timing of markets. We understand these markets better. Our macro timing is better, which allows us to make decisions on behalf of you. So you really don't have to worry about picking where the rates are better, what is the credit quality of these instruments. We do that for you. We do that evaluation, and we create a pool of assets that you can directly invest in through a unit trust product. Right? So very clearly, unit trust has an advantage, and CAL will have an advantage because of the longer term maturity of the fund. The other asset class, which is now gaining popularity, is equities. Right now, historically, and in terms of the market today, the all share price index is trading at somewhere around 11,000 to 11,500 levels. We are looking at the market can even touch 13,500 to 14,000 levels in the next 12 months, right? And I'll tell you why we expect this and why the stock market can be an attractive proposition right now, right? So historically, if you look at it, interest rates and all share price index have a very strong correlation, right? And how it works is that when interest rates come down, we've seen market goes up and vice versa, right? So why? Because if, for example, if interest rates are very low, to be honest, people or investors don't feel that it's sufficient amount of money that they are making in terms of return, right? So they look at alternative asset classes, right? The alternative asset classes, Sri Lanka has a very few alternative asset classes, right? So equity is one particular product, right? So if even 1% of FD mature and come into equities, we see roughly about 10-15 billion rupees of money coming into the equity market, which is a large amount of money, which can push the equity markets very high, right? So if you look at it, there is a very negative correlation, or very high negative correlation between interest rates and the equity market, right? And now with tax-adjusted FD rates being lower, right? Now we know that if you put a FD at 11%, you're only going to get 7% to your hand, right? And very soon that 11% rate will also reduce, because when central bank reduces rates, your FD rates are going to keep coming down, right? So the tax-adjusted FD rates don't make any sense at all, right? When you compare it with for investors, which will make them to look at alternative options like equities, right? And one particular product that that people come into is equity. So the trick is, before everyone starts coming in, you need to start entering into the equity market, right? Now we've seen 2-3 quarters of bad earnings growth, right? Companies were doing badly, but now you're seeing economic growth coming back, right? Which means that companies will start doing better. Interest costs of the companies are coming down. So corporate profits also will start improving from the December quarter onwards, right? So that also will kind of help the companies revalue itself in the market, right? So share prices will move up when profit starts improving. So this also helps the momentum to continue in terms of equity market. And all share price index and credit growth have very strong correlation. Now we are seeing Now, if you look at last month, was the first time we've seen after 14 or 16 months that private sector credit has turned positive. That means that people are now starting to gradually borrow, right? And in a period like that, we've seen strong correlation between the credit growth and the all share price index, right? So that will also kind of help for the market to kind of move up, right? So how do you gain exposure to equities, right? How do you invest in the share market, right? So either you can invest directly in the stock market by opening your account and trading in the shares, right? For that, you need to have a little bit of understanding how things work. Obviously, CAL will help you through the platforms in terms of giving the support, the necessary recommendations, the platform, and even a research database which we launched a week ago into what is called Analytica. So the platform is given in terms of if you have a time to trade in the market, right? But say, for example, if you're a passive investor, you don't have time to do this. You don't have time to kind of spend in investing in the share market to find what good shares are, do your own research. Then we would recommend taking the Unit Trust Fund route, where the Unit Trust Fund, we have a specially dedicated equity Unit Trust Fund, which invests in the share market. That's what we call as a quantitative equity fund, right? So you just put the money in and the fund managers will kind of manage those funds for you, right? So that's a passive approach, right? But if you are someone who would like that kind of the kind of active trading, then we prefer you to take the direct investing route in the equity market, right? So this is the fund performance. I mentioned to you about the equity fund that CAL manages. This is what you call the CAL quantitative equity funds. If you have invested 10 rupees in 2013, obviously your return today is almost like 40 rupees today, right? So over roughly about 10 years, right? Even though markets have been choppy, country has been doing well, the performance of the portfolio can be seen here, right? So roughly, if you work out a weighted average return for a year, it works out about 15% per annum on an annual basis, right? So this is in a bad time when economy was not doing too great, right? Obviously, we had struggles in 2019, 2021. Even in this period, we've been able to outperform the market by a large amount, right? So one option is taking the route of investing your money through a stock market account, a stock market unit trust fund, which we call as a CAL quantitative equity fund. So you can either take a passive approach and put money in the equity fund and make returns through it, right? Keep in mind that equities always has a downturn risk, right? Because downside risk, right? Equities can always come down in value if there is a reduction or change in economy. If economic fundamentals change, yes, the equity market can come down. But also there is a benefit in terms of taxation, right? Equities is zero tax in terms of the capital gains that you make, right? So if your share price goes up from 10 to 20, you don't have to pay a tax on the gains, right? The only tax that you pay is on the dividend income, right? So if you make a dividend, you pay 15% tax on it, right? If the company declares a dividend, you pay a 15% tax on it. On the capital gains, you don't pay any tax at all, right? So that's a brief in terms of what we are looking at and what we can recommend to our investors. So at the moment, easy route would be taking the unit trust funds. Second is equities in terms of the share market. And also when debentures come out with attractive rates. So you have to be careful in terms of what rates you invest. It should give you a return higher than the treasury bonds. And also you need to be wary of what kind of credit quality those instruments are, right? So these are important when you're making a choice in terms of what investments that you kind of make, right? So on that note, let me take a few questions. So the question is, in this FD, in the FD tax calculation, how does it work? Can the bank directly deduct tax from interest income, or is it a voluntary thing that we need to do, right? So as of now, it's a voluntary thing that you need to do, right? Say, for example, at the moment, what the bank does is the bank minuses off the withholding tax of 5% and gives the money to you, right? Then you have only paid 5%. So if you're falling into the 36% income tax category, you need to pay another 31% more effectively, right? But you have to voluntarily file your returns. If you're showing your portfolio in your tax files, then you have to declare it and pay it as a separate income tax to the income tax department, right? As of now, there's a fairly large percentage of people who are still have not been don't have tax files or have been identified. But in the future, you'll see this coming in, where the government can track all your investments and so on. The government has invested in sophisticated system. They're getting a system from India in terms of digital NIC. There has been the systems which can track basically the incomes and so on of people, and particularly all financial institutions returns. And if you have an FD in XX bank, all these returns will be accumulated by the system in the future, right? So still as of now, it is entirely voluntary, but in the future they can identify who these people are who are not kind of paying if their interest income is above X amount of money. Do we have to pay tax after 5 years on fixed income opportunity fund capital? Yes, you have to. So that is also voluntary, right? You don't have to pay WHT because the rates that we quote you are after the withholding tax. So you don't have to worry about the withholding tax, right? But in 5 years' time, if it depends on the interest rate at that time, right? So if the interest rate at that time is say 15%, you need to pay the 15% tax for those 5 years, right? But because you've been postponing the payment, there is a return that you kind of make, right? Because the amount of money that you have not been paying as tax earns the interest for that particular period. So net, you're making a gain compared to paying tax on this particular year. So investment grade daily return fluctuates significantly, even negatives on some days. What is the reason for such variation? So at one particular point, we had this issue, right? Because some instruments were required to be marked to market on a particular day basis. We had the issue where, for example, when rates go up, your return comes down and so forth, right? But now I think from 2 or 3 months ago, we have made it fixed in terms of the returns, right? So you won't see volatility in your funds like what you saw before, right? But keep in mind that volatility helped you in those couple of months before, right? What happened was when rates went up, there was negative returns, but that also helped us make those abnormal returns because when rates came down, right, you saw capital gains on your positions, right? So that fluctuation that you saw 3 months ago is not going to be there because now it's more like a cost plus accrued kind of portfolio. Right. So the next question is, what is the guarantee or safety of the unit trust, right? So to be honest, there is no guarantee or anything. It is a risk. It is compared to a treasury bond. It's obviously a riskier product, right? The good thing with a unit trust is that, say, for example, as a fund management company, we take 100 rupees from you and invest in 10 particular instruments, right? At a given time, you're not going to lose all 10 instruments, right? Because the portfolio that the investment managers are investing is diversified among multiple investors, right? If one particular investment fails, you'll still have 90% of the investment, right? So the portfolio is diversified, right? So it's not like with a financial institution. If the financial institution goes bust, you lose the entire 100% amount out, right? But with a unit trust fund, if one particular instrument falls, right, you only lose 1 out of 10 or 20 out of your investment, right? The second thing is that we've been operational from 2012. We had 0 incidents where there's been no default on a portfolio as such, right? What are the withdrawal conditions on quantitative fund which purely invest in listed equity? To be honest, we don't, if I'm not mistaken, we don't implement exit fee as such, but when you buy and sell, immediately there is a brokerage impact, because when you're investing like the stock market, when you're buying shares, you're incurring a brokerage percentage, and selling shares, you're incurring a brokerage percentage, right? So if you invest today, right, and the market doesn't change, automatically you're at a loss because it takes into account the commission percentage, right? So because of that, right, your quantitative equity fund needs to go up in terms of performance for you to cover up the brokerage component. So what is the custodian fee in the unit trust? You don't have to worry about the custodian fee because CAL is bearing the cost of it, right? So the returns that you're making is net of all the custodian fee, right? So you don't have to worry about what custodian fee CAL is paying and so on. Is you, as an investor, you're not paying that tax. It's by the return that we are quoting here, right? And what I say is you can make 20% plus returns in the foreseeable future is after all these fees have been deducted by the fund, right? So what are the rates running on fixed income opportunities fund as at today and the investment grade fund? The rates running, I would now, every day the rate changes, right? But I can tell you that our rates will be above north of 20% for at least the 3 months, depending on, it depends on current, for example, if you have a 30 billion rupee fund and there's another 30 billion rupees fund, we have to find places to park that money. But looking at current conditions, we can give a 20% plus return on both funds is our view, right? And why one fund will be one lower and one fund will be higher is because it depends on the new inflows. Now we see a lot of money starting to come in. If one fund sees a lot of more new money coming in, then of course that return will go down faster because of the new money being have to be parked at lower rates. So where we can get comparison among the different unit trusts. So we have fun fact sheets on our website. So if you go to our unit trust page, you can see the different funds, and there's something called a fun fact sheet where you can see the maturity profile and so on, what I've been talking about. Do we get equity dividends with equity fund? No, we don't. We haven't been declaring dividends with equity fund because we feel that capital appreciation potential is there. So if there's a period where we feel that capital appreciation is limited, then we might want to declare a dividend. But as of now, we don't do that. What is the difference between fixed income opportunities fund and versus the investment grade fund? The investment grade fund is more in terms of credit quality. It only invests in BB plus kind of instruments, right? And a lot and these are relatively high in terms of credit quality compared to the fixed income opportunities fund, which can slightly go down in the scale in terms of investing in a more riskier kind of product, right? Is there a particular confirmation issued on the unit holder's income if there's a request by IRD? This is to verify the realized income on fixed income security. Now, is there a particular confirmation issued on the unit holder's income? So the thing is, the terminology now, what you get on the unit trust return is not a realized income, right? So in the IRD, whatever, it's mentioned as that any realized return will be subject to income tax, right? But now we've been working on this for a long time. If the income is not realized, if you haven't withdrawn the money, then you can comfortably kind of postpone the payment, right? Not that you're not paying taxes, right? The idea is that you're postponing the taxes, right? Because when you withdraw, even if you invest in FD, right? If you have an FD which is giving you interest at maturity in 5 years' time, you only have to pay tax in 5 years' time when you're getting that interest component, right? Could you potentially lose a portion of your or the entirety of your invested capital when investing in unit trust fund? Yes, you can, right? Like what I mentioned, apart from treasury bills and treasury bonds, which are considered risk-free, but we've seen a period where those have also been considered risky. Any fixed income investment or any financial instrument can be subject to a default, right? But as I mentioned, the thing is that the diversification benefit and our credit quality evaluation ensures that this doesn't happen. So which is why I said we have a track record where we haven't seen any defaults on our funds as of now. There's a question in terms of how often do fund management companies furnish information to the Department of Inland Revenue? To be honest, as of now, they have not asked us for it, and we haven't also not kind of furnished it. But at the end of the day, at one particular point, everything is going to be tracked. So just keep in mind. But as of now, to be honest, it's not something that we give or they have been kind of asking for as well. Any Sharia investments available? At the moment, no, but we are trying to develop a product which might come to the market very soon. So if you want to learn about this unit trust product, go to our YouTube page and we have videos telling you how it works, what the benefit is. It looks too good to be true because the rates are good. I know, I understand where your concern comes from, but as I mentioned, it is because of our positioning in the market. And you know that rates were high at a particular period, which is why we've been able to lock in and kind of give those returns, right? So it's all on proper credit evaluation and things like that we do to evaluate and make decisions as such. There's a question in terms of why did ASPI come down over the last few years, last few days. So one reason it came down was there was a bit of profit taking because people have made money. Second one was the postponement of the domestic debt exchange program, right? Because of the postponement, what happened was people thought, okay, there could be some problem with attached to a domestic debt exchange and so on. But to be honest, as at 31st August, the likely scenario is that will be comfortably passed through. So you won't see too much of an issue in terms of that being a problem, right? The other thing was we saw a bit of foreign selling on few shares, right? And that kind of drove the market down. But now we are seeing kind of the interest kind of building back again, right? What you need to look at is the overall trend. It's good if there is some adjustment when it goes up. Continuously markets going up are not healthy, right? We've seen what happened in the 2020 to 22 run, right? Markets went crazy and then it adjusts itself, right? But this run has been more cleaner. We've seen fundamental companies go up more, and it's being a more it adjusts itself when it goes up. But the overall trend is good, right? And when rates are kind of coming down, you're going to see that kind of market movement continuing. I'm unable to kind of comment on individual shares. Our research division will do a presentation on particular companies that they're interested in and why they would recommend it. At that point, I think we could answer the questions that you have on the individual counters. Can we switch between unit trust funds? Is it advisable? Yes, you should be switching between unit trust funds. Depends on the timing. Say, for example, you're seeing inflows coming to one particular fund more, then to be honest, it might make sense to shift it to the other fund, right? So there's no cost involved in terms of you shifting. It's a matter of logging into the CAL portal and just say switch funds or whatever that option is, and you can shift from one fund to another. And keep in mind, the advantage is that you can shift from fixed income funds to into the share market. You can use the portal to manage your entire portfolio. So you don't have to be running between financial institutions to do this. You can manage your investments within this portal by moving your assets around, and you don't you're not incurring cost, or you don't have to go to a bank to transfer funds and so on under this system. Does switching between unit trust fund consider realization for taxes? Yes, it is considered. So if you keep switching, to be honest, then it means that you're realizing income and then you have to pay taxes, right? So from a taxation perspective, you're looking at, if you're falling into that category, recommendation is that you don't do you avoid switching, because switching means you're realizing the funds. So that's about in terms of our session. So what we'll do is there are a few equity related questions that were asked by our customers. Our research division will have our recommendations and so on being published in the equity session. But what we'll do is on a monthly basis or so connect with you in terms of telling you what has changed, and in that kind of context, how you need to kind of tilt your portfolio. If you have any questions, you can contact us via email, or even on our social media pages. You can drop messages and we will be able to respond to you. Thank you so much, and we'll hope to see you in another session soon.